Good morning. On today's show, we are going to talk about how do you know when volatility, implied volatility is cheap, and what to do when it is. I'm Lex, and this is the Brew. Tune in. Good morning, lads. How are you? The Traders Workshop. What's going on?
Hello.
Hey, Lex, what's up?
Not much. So, cheap IV, is it really cheap or not? That is the question. So, before we start, trading a lot in this environment. I don't like it as much as high volatility environments, I must say. Now I know why I was a trader back in the day. This cheap IV stinks. It's golf time. No good. I don't like it. Mark, what do you think?
OCC volumes are down. You might still be trading as much, but it feels like yesterday was okay. But Monday, Tuesday were dead.
Yeah, they were dead. It's holiday time too. Our volumes are way off. But I think, and this is what we're going to talk about today is this cheap IV potentially. I think though, when you have lower levels of implied volatility, it just feels like it's natural that volumes are lower or lighter. I just find it, trading options in low volatility environments is hard. I really do. And so does probably everyone else for that matter.
It's hard to sell, even though that's what you should be doing.
Ooh. Now there's a nugget of truth there. So let's get into that concept. I'm glad. Did you plan that? That's like a lead. That's a segue. I love that. Layup. So is it? How do you know when IV is cheap? I'm gonna let either you, Mark, or Jason. Probably Jason's topic here. An absolute number. We always talk about VIX. VIX with a 12 handle seems cheap. VIX with a 20 plus handle seems expensive. But is it actually cheap and actually expensive? Because it's relative to something, right? Is that safe to say?
Yeah. So first of all, determining whether something is cheap or expensive is kind of a function. Hold on. Okay, I didn't have to see.
Did you just cough up a Flamunda cheese? Was there just a Flamunda cheese that came out of there?
No, nothing. I was expecting a sneeze, but it didn't happen.
Okay. So
it really depends on your feelings on how to determine whether anything is cheap or expensive. Just to kind of like a little example, during COVID, we had to buy a new car. We bought a minivan, and if you remember, car prices were kind of high, but they were above MSRP. I ended up getting it for MSRP and thinking I got a bargain. But a lot of people were saying, "Oh, car prices are going to come back down," and eventually they kept going up. So even though it seemed expensive, it really wasn't, because now if you wanted to get that same car, it's more expensive. And implied volatility is kind of the same way. It's trying to look forward at how much the markets will move as opposed to anything else. So it is really a supply demand driven kind of metric. But some ways in which you can look at, when I thought that my minivan was expensive when I was buying it, it's because I looked at the prices that it was for the past year or so and said, wow, this is expensive compared to what it was. I had no idea that the prices would keep going up a year or two down the road. And, so when you're looking at implied volatility, probably one of the first metrics I look at is historical volatility over the past 30 calendar days, 23 trading days or so.
Yep.
What was the volatility in the whatever underlying that you have?
Yeah. So let me interrupt real quick. Sorry. Just define it. I know you kind of did there, but let's make sure we know the difference between historical vol and implied vol. And this is for maybe some of the newer folks who might not understand that. So historical vol is looking backwards on the underlying asset, right?
Yeah, it's realized volatility. It's what has already happened. So there's no forecasting. It's only as the number itself is only as volatile as the last instance that you're looking at, the last day or,
Yep.
5 minutes or whatever, and compared to the new one that is popping up. So, I mean, it's kind of like a rolling volatility measure.
Okay.
Implied volatility is forecasting looking forward as to how much volatility you think there will be. And basically that's kind of measured in the premium of the options that you have.
Okay. Got it. Mark, anything to add there? I know you and I are old timer trader guys. Maybe we thought about it differently. What do you think? Anything?
Yeah, I mean, I think you asked the question at the beginning. This will put a little philosophical spin on it first, but like, how do we know if it's cheap or expensive? Just because something's cheap doesn't mean it's a buy, and just because something's expensive doesn't always mean.
I think he was going to say doesn't always mean it's a sell.
Like those.
He flipped in and out there again. It's the Brooklyn internet or something like that. It's a special kind of internet.
Like a cheap internet doesn't necessarily mean it's a buy, Mark.
No, that as we are seeing right here, apparently, it's too bad because my internet's not cheap. But no, to add on to the historical volatility comment, I think it's important to like put into context what the
volatility.
I think I better close my trade hawk. It's hogging up all my internet bandwidth.
Oh my God. Yow. Ouch. So I think you said
the opposite thing.
Yeah. Try it again, Mark, real quick. So I want to make sure we get it right.
Okay. Sorry. I think it's important to put in context what the volatility environment is, right? That like you can't say VIX 12 is absolutely low or 40 is absolutely high, because it like depends on what it's been doing recently. And like what the general like historical recent context is for that vol. And that's why I've been using a little bit of some Garch modeling in my pricing as like a comparison, because it's sort of like a 201 version of just the basic historical vol calculation. It looks at a little bit more what the vol context is and, how dependent the past is going to impact, the future of vol.
Okay. So then you could potentially, using that model, Garch, I'll let you tell everyone what the 5 letters stand for in a second. Or was it 6 letters? 5. So using that model, then you could actually assemble trades that buy premium in higher absolute implied volatility environments and the opposite in low implied volatility environments. Is that correct? Potentially, because Garch might say, hey, vol is expensive, absolutely, but it's not expensive enough compared to what's going on in the environment.
Exactly. Like I will typically take like spreads that are in the market and say, okay, the current price of this spread is $32, like a SPX at the money straddle. Like tomorrow's straddle is $30. Garch, according to the historical vol, if we plug in that historical vol that comes out with, or it's not really historical vol, it's a predictive vol because it's predicting based on this history and past experience of that. That's saying that straddle should only be worth $23. And so to me, that says, okay, it might be absolutely low, at the money vol and SPY or SPX is like 11, 12 right now. But compared to what Garch is saying the recent history has done, this should be even cheaper.
Gotcha.
Now, I have to take that into context, right? We just had Thanksgiving. We have the holidays. Garch doesn't know that necessarily. But, as a, indicator of what, how we are relative, I think that's a good, kind of barometer.
Okay. Now, sorry, let me ask Mark real quick, Jason. How can the everyday retail person use Garch? Is it on the bookshelf? Where do we get the model, or is it something so esoteric that only the pros have it?
There are a number of places you can get it. My software provides it for people, but
hello, I can't put up layups any more than this. My God, I'm throwing beach balls in the air here.
I did throw up a screen share. I can show you what I'm looking at for SPX straddles.
Let's do it. That's the this.
But it's a fairly like off the shelf parameterization in terms of like what the model does. But basically, it weights like past experience and current environment, and those are like the auto conditional and the regressive components of heteroscedasticity, which is the variance of volatility.
Okay.
So like, yeah, this is the next 2 weeks of SPX straddles, and we have the live values, so $9 more today, $4 and $5 more later out. We do have some speakers today, tomorrow. Like, I understand why there might be a little more, why there might be a little less in the past. But to me, I see this, and I've been putting on some like short-term straddle swaps to like protect me in the back month, but collect the short-term decay.
Okay. So like
back month, like 2 DTE versus 1 DTE.
Okay, I got you. Yeah, and that's funny you say that. I was doing the same thing, interestingly, without having this model, because I noticed a similar kind of setup. So that's been very effective as well. How does it take into account weekends? What I mean by that is, if you're looking at a Friday to Monday, Monday looks cheap at first blush, but it really isn't necessarily, because it's probably computing in 2 days of non-trading there on Saturday and Sunday.
So the Garch model, when it comes up with the historical vol calculation, it knows what the calendar of history.
I got you. Okay, that's good to know.
And the implied vol is just that's currently what the market's pricing.
Okay, so it looks like what you have here in the live value versus the value, the Garch value, looks like live's inflated, relatively speaking, right?
Yeah, I think so. By this is SPX specifically, but it's trading $9 over for Friday, $4 over for most of next week.
Right.
Earlier in this week, we were seeing this even higher. Now there, I was a little more tentative to put it on because I'm thinking Garch is going to be biased by the holiday environment.
Yeah.
But in some ways, that's also where you're like, well, nothing is happening, right? We've been pinned right around 45.50 in SPX. So
yeah. So what can you do with this? I mean, what can a retail trader do with this? I know this is saying maybe we should sell something. What's the most advantageous thing to consider? I mean, obviously they're not going to have the wherewithal to go sell a straddle, right? They just can't do that. Is this telling us we should set up an iron condor or short iron condor or something other? Any thoughts on that, guys?
Definitely don't recommend selling naked straddles, but I think condors are a good call. And I think we're going to pass the ball to Jason for a setup on like how to find that condor, because you're way better at setting those legs than anyone I know.
Yeah. So you like the iron condor, even in absolute low implied volatility environments, but when the Garch is saying it's still too high, everybody, you're still going to maybe look to do an iron condor potentially, right?
Yeah, or I like the straddle swap. You can put on a straddle swap in a margin account, but you do have a defined risk there.
Yeah.
Of course.
And a straddle swap is just selling a front month expiry, buying a farther out expiry in the straddle.
Yep.
Okay. So can be called 2 time spreads as well. One on the put side, one on the call side, but a straddle swap is way cooler. I got it. Anytime you use the word swap in options and trading, it sounds really like Goldman Sachs trading desk. I love that.
That's when you're dealing with equity derivatives, not just options.
There you go. Jason, you want to weigh in on this relative to Volland? You want us to pull that up?
So, I mean, I could show you relative to Volland, but really quick, one thing that I want to mention, even though Garch is backward looking, kind of like what I was saying with historical volatility. Tomorrow, my boy J Powell is speaking, Jerome Powell. So it may not be completely expensive because we have, what little bit of event vol, you can say.
Sure.
But one thing that Volland is very good at is showing you what that event vol is. Also, if you want, I could show you some new features. But anyway.
Totally agreed, by the way. You've got to take into context, like Garch only knows what the path. You got to say, okay, and look at the calendar or whatever, what's going on. Totally agree.
So here, I mean, right now we're looking at probably more like a bullish structure for tomorrow.
What are we looking at, Jason? Sorry. What month is this? Is this tomorrow's?
Tomorrow's expiration, not including today. Gotcha.
Okay, so it's tomorrow, and we're looking at Volland, right?
Yeah, this is the tenor that Mark was looking at. He's looking tomorrow, and Garch is looking at trying to show what the difference is between the historical volatility and the implied volatility for tomorrow.
Okay.
So what this is showing you is how much notional exposure dealers have to that to tomorrow's existing options.
Okay.
People
so what
obviously
are we looking
know.
at with these green bars, these big green bars? Tell us about what this means.
So Vanna, it means that it is the Vega's exposure to moves in the underlying, which is like basically a slope of a Vega curve, or you can interpret it as delta's changes in relative to implied volatility changes.
Okay.
So when you see Vanna with with positive Vanna below current price, that means that usually you're short options.
So short puts.
So dealers right now are short options below price, probably puts.
Okay.
And we can even down select and see if they're puts, and yes, they are, right?
Okay.
And then, but they are long options above the current price, calls or puts. And you can see if tomorrow, if they are calls, yes, they are long calls, which means that customers, whoever's on the other side of the dealers, have bullish collars on, probably hedging bearish collars on, probably hedging a bullish underlying position, right?
Okay.
Would you agree with that assessment, Mark?
Yeah, I mean that's what
that makes sense to me.
Yeah, that makes total sense. So,
yeah, I mean we don't see the stock necessarily underneath, but that seems to be what customers are doing.
Right.
So as a result, dealers, if implied volatility comes down, which it very likely will with Jerome Powell talking tomorrow, then dealers are going to have to buy in order to hedge this position that they are holding.
Okay, because because they're not going to be as long in the options, right? Or in the case of the short put, they're going to have to buy back short stock any way you cut it.
Right. So implied volatility goes down on these options out of the money, then their deltas are coming down, which means they have to buy or buy to risk adjust their book.
Got it.
However, what the people are actually hedging here is Jerome Powell saying something big, and it seems like from what Mark has observed using his Garch model that people are pricing in quite a bit of volatility for tomorrow. I think for some reason, some people think that Jerome Powell is going to say something that could move markets. So really, the assessment is the market overrating what Jerome Powell is going to say tomorrow, or are they not? And that's kind of the decision you make. But when you're looking at goalposts of what does overreacting mean, when you look at Volland, you look at these big, huge Vanna spikes. If we drop below 4,500, then the market did not overrate or did not underrate what Jay Powell was going to say. And even more so here at 44.50. So if he says something like, I'm going to raise interest rates, 200 basis points, and we fall down here, then the market was underrating really what Jerome Powell was going to say. So you kind of have to keep in mind that implied volatility is forward looking, while Garch is backward looking, and you kind of have to see the context of what Garch is looking at versus what you're looking at moving forward.
So with all this knowledge now, all this data we have between the two of you, Mark, you like the Iron Condor. Jason, do you like anything in particular different from Mark, or how do you play this?
So, I mean, for me, I'm probably not going to go with a Condor, and primarily because I don't know what Jerome Powell is saying. And it seems that, the options traders, are kind of scared. And if they're scared, then I'm scared. Probably what I would do personally is stay long gamma and maybe target this 46.50 area. I mean, not that far up, but I mean, these are the calls that people are selling. Okay. So if you can put on like a long gamma vertical for very cheap tomorrow, going higher, that might be a good play.
So my little 2x1 strategy to the upside might be a good play if I get it for a little bit of a credit, huh?
Yeah, I think so. I mean, you might find yourself disappointed in your gains
Yeah.
if like the market goes up, 40 points and you just gained your little credit.
Yeah.
But if you're being safe, I mean that the 2x1 is the ratio spread is a good idea.
I love the ratio spread in lower implied volatility. Even if I should be selling stuff and I can get the ratio for a credit, I'm kind of solving my problem, right? I'm kind of selling something, sort of, but I also have upside gamma if I'm doing a call side, right? And upside explosion sort of results, which I also love.
Mm-hmm.
What I would say is I've traded these for the last, I want to say week-ish, maybe not so much during next Thanksgiving. The money that was made has always been, they have expired worthless, right? Because by just, I don't know if it's luck or sheer nature of what's happening, we have these big gap ups. You can put these things on near the at the money, not at the money, essentially you're short, but near. They never even breach or never come near that short strike. They just kind of drift back down a little bit and it just sits there and rots away. And I'm like, okay, this is kind of dumb easy right now. I don't like it. It scares me.
Yeah.
So,
I mean, I was talking, we talk now about Volland and the lines in the sand when there's when dealers are short a lot of options, and really all you kind of do is look at Volland, see the largest strikes when the downside is red, you see red bars, and the upside you see green bars. Like, if I take out right here, you could be looking at like 45.20, 45.30 as your short strike for your condor.
Yep.
And 45.85 as a short strike for your condor. It's only 10.22.
Yep.
So you might get some credit for that.
Yep.
In SPX you get $1 credit or something like that, and 50 cents credit on a 5 spread. You might make yourself some 10%.
Yeah. Okay. I like it. Yeah. So my struggle has been with these things is when to take them off. I like to let them go to zero. Now I know you're going to say that's not what you're supposed to do.
No, I would say let it go to zero.
You would.
And you're going to see some statistics coming out from ad dam funds, our shop.
Yeah. Okay.
From ad dam funds.
Yep.
And we the paradigms where customers are just buying calls and buying puts. When we determine boundaries with just even the largest strike on these things, it has a really good success rate.
Yeah, good.
Like
I've been using it. I don't use it
in the high 90s.
Yeah, no, I love using it, and I want to use Mark's stuff too because I like Garch a lot.
Mm-hmm.
But Mark hasn't taught me how to use it yet. I'm gonna learn though.
We can do a tutorial there.
I want to do a tutorial. No, but I've been using all the tools at my disposal with these things, these zero DTEs. They have me up at night, even though I'm not up at night because they expire, which I love. So I'm not really up at night because it goes off my sheets and I get a notice from the clearing firm that I've been assigned or exercised and it's cash and I don't have to worry about it. So it's a beautiful thing. But yeah, it's been, I know why retail people love these things. It totally makes sense to me why they love these. And I think, I think it's only going to grow. Hate to say it.
Yeah. What was it earlier this week? Didn't NASDAQ launch zero DTEs on like GLD, TLT?
I saw that.
Silver.
Yep.
Nat gas. Nat gas is like trading at $5 or $5.50. They're putting zero DTEs. What are you going to do on that?
I know. Yeah, I know. It's crazy. It's crazy.
Yeah.
But
while I'm saying it's crazy, we do have those zero DTEs in Volland. So
I know. I got
we have them. So, but yeah. So I think that with SPX in particular, because so much notional is traded, the other thing too is if you look at the CBOE open close data,
Yeah.
You notice that in zero DTEs, a lot of it is dealer-to-dealer trading.
Yeah.
And, we kind of said, I think they're like sharing their risk, But I think also even sharing risk, if I go here to Vega exposure on SPX for dealers, it's strongly negative. I mean, we're looking at negative almost 1 trillion.
Wow.
Which is, historically, that's pretty strong.
But all this means to me, I don't know where the middle point is here, but they're short downside puts, and it looks like they're long upside calls, right? Like they always are.
Like they always are.
Yeah.
But that being said, though, I think what they're doing in zero DTE, since there's a lot of dealer-to-dealer trading, is they're going long Vega with cheap options. They're buying the puts and calls, so now they're hedging their volatility. Yeah. And then the zero DTE book is saying, okay, well, we'll manage this portion of the risk. So they're kind of, I think they're helping each other out with their books.
Okay.
But that's just an assumption. I don't know that for sure, but
yeah. Okay. All right. Good stuff. Mark, anything else before we hit the high road?
Sell cheap vol.
I love it. Garch says sell cheap vol. Well, I have been. I mean, look at you. You came from a premium buying shop more than a premium selling shop. Is that fair?
We were net long.
Yeah.
Yeah.
Okay. So we were probably the opposite. We were probably net short generally. But we would
probably counterparties.
Yeah, we would definitely buy it though. I mean, listen, we if we had to, we buy it, but we preferred to be short it. And we had individual outlier traders who love being long it because, look at there's a big difference being long premium as a professional when you can buy your bid and sell your offer versus being long premium as a retail trader when you cannot do that. There's a big difference, right? Yeah. So you can swim in the army clothes with long premium as a
it's also possible.
What's that, Mark?
Oh, did he freeze?
He froze.
Yeah, I was just gonna say, I mean, like even like good tail risk strategies, even like a lot of the clever tail risk funds that are out there, like they're net paying a little bit of premium on a given basis, right? Most days, like they're like paying premium and having that exposure is like, it's about how to tread best that water, right?
Yep. No, that's a good point. We have, I think we both all know the same group who does that well with Chris and Will from Ambrose. That's their strategy is they have a tail risk fund. And, we won't get into that today. Maybe we'll have them on and do a talk about that. That'd be interesting. But yeah, I think by and large, the retail guy and gal have difficulty being able to manage the long premium side of things. It's much harder. I think we typically see mostly folks selling very risk defined strategies in the retail side. That's what I think is generally happening. But could be wrong.
I think it's easier to systematically sell than it is to systematically buy.
Yeah, I agree. Makes sense.
I just sort of thought about that, but I don't know why it.
Yeah. Well, the sell part of it is it doesn't take tender loving care necessarily. It takes a fire basket or a fire hose at times to get out. But, I can sell something if I can walk away a little bit, right? And because the time is helping me, right? So the worst thing to do is watch it. You should have your parameters set that alert you to problem situations, but
it's a psychological thing.
Yeah, I know.
Yeah.
Like right now, I'm in and I'm short.
A small drip for the spike, or you want the little stairs and the
right. Yeah, I'm in right now on the short side of things. Not short deltas, but short premium, and I'm
short
looking at it.
P&L.
I keep looking at it and I go, okay, if I look at it in 5 more minutes, it'll be higher. Okay. I keep looking. Get out.
Short P&L.
No, it's good P&L. It's good. I hate it.
No, I know. I'm
good P&L. All right. We should go. Great conversation on cheap volatility. You guys have a good rest of the week. It's almost over. Have a great, weekend. Drink some good wine. Eric, you're not going to do that, Jason, I know, but Mark is. I'm getting shipment galore. I was just in Napa. Shipment galore. They're hitting my front door every other day. It's
Oh,
unbelievable.
well, you will have a good weekend then.
I'm gonna have a good weekend. Yeah, it's kind of guys' weekend, which is kind of fun. We'll all drink some good stuff. Starts tonight.
Nice. Thursday's the first day of the weekend.
Yes, sir. You guys have a
You gotta
great rest of the
play
week.
poker to pay for it all.
Yep. So, Mark, happy trading. Jason, live it
Happy
up.
trading.
And we will see you next Thursday on the Traders Workshop.